The Nigerian Society of Energy Editors Energy Sector Outlook for Q4 2025 indicates that the sector is facing a dramatic final quarter, just as a historic peace deal, talking about the Ogoni deal, offers a bright future for production, while crisis at the Dangote refinery, which has been resolved, has actually put the country on the brink of a national fuel shortage. Let's look at the numbers at this time. Now, oil production is expected to hold steady at 1.62 to 1.70 million barrels per day. Now, but major security breach could actually quickly reverse these gains. Nigeria now relies on Dangote refinery for more than 60% of its fuel supply, and any more labor disruptions could force Nigeria back to costly fuel imports, gotten the massive $5 to $7 billion in annual foreign exchange savings the refinery was supposed to provide. Now, this is in addition to inflation risks, where the report says fuel crisis could push the rate back towards 25 or even 26%. The sudden loss of FX savings will put severe pressure on the naira, pushing the exchange rate into a weakening band of between 1,500 to 1,650 naira to a dollar. Power supply, already struggling at about 4,300 watts, will be further stressed as businesses and homes scramble for expensive diesel due to fuel shortages. The report recommends that government must resolve the labor crisis immediately to prevent a devastating economic crash from wiping out the hope brought by the historic peace deal in the Niger Delta, talking about the Ogoni new peace deal. Now, positive indicators in summary, talking about the crude oil output as well as the energy exports. These are largely stable and they show minor growth, reflecting long-term potential from deepwater projects and the diplomatic progress in the Niger Delta, talking about the Ogoni land. These are also structural strengths of the sector at this time. And looking at the negative indicators, talking about the Dangote labor issue, inflation, the naira, the petrol prices, these show extreme volatility and a strong upward risk. The utilization rates at Dangote, which is about the single unknown, its failure to direct feed into higher inflation, it will cause a weaker naira as well as soaring petrol prices. In essence, political stability is being overshadowed by operational instability, and the gains of expected by Nigerians might not actually come. But if these issues are resolved, the report says Nigeria is on the path of energy sufficiency. That is it on this first report. Now, a quick look at the markets. The close of trading on Wednesday presented a mixed picture across key African exchanges, with South Africa making solid gains. Nigeria easing off its recent rally and Tunisia experiencing a slight pullback from its all-time highs. The Nigerian exchange market saw a slight dip, closing in the negative after a period of robust gains, while the oil and gas and insurance sectors recorded modest advances. The rally was actually largely moderated by investor repricing and profit-taking in the banking sector despite strong overall trading volumes. Looking at the South African market, it had a strong day driven by primarily its mining sector. Major producers like Gold Fields as well as Anglo Gold Ashanti saw significant increases, potentially benefiting from a weaker US dollar environment. For the Tunisian market at this time, the exchange actually closed down marginally, just shy of its recent all-time high set earlier in the month. This small decline is likely attributed to consolidation after a strong year-to-date performance. The final quarter of 2025 is setting up for a fascinating period in the global investment market, with emerging markets gaining more investor